Hi everyone, I'm John Mackay, Head of Distribution at Hartford Funds. Today I'm joined by Tarit Rao-Chakravorti from Wellington Management. Wellington is one of our long-standing sub-advisory partners, and we're going to spend a few minutes today on international investing, specifically international value, what that means, where the opportunities are, and how Tarit and his team are approaching the opportunity set. Tarit, let's begin with a little bit about yourself. How did you get your start in the industry, and specifically, how did you get an interest in investing in stocks, and what drew you to Wellington Management?
Sure, thanks, John. So, I had a bit of an unconventional start. I was a conflict studies major in undergrad. And when I originally joined Wellington, I started on the product side, working with the international value team. And I think that was the perfect place to start because you get to listen to different portfolio managers and you think about what makes sense to you. And to me, the idea of buying stocks at 20-year lows and just waiting for things to get better seemed like the only way that I could think of to make money in the markets. And I was very lucky about 13 years ago to pitch a stock that got into the portfolio, and that was really the beginning of the bug for me. And then I took a break from the industry. I worked outside in the national security space, and then coming back, I knew that this was the only type of investing that I wanted to do. That focus on places where people are uncertain, where things are volatile, and just hoping to be patient and hopefully a little bit more rational and take the long-term view. It's really been just the right philosophy for me. It's not for everybody, but it's the one for me.
I think I'd take two quick things away from that before we get into the strategy in the space. One is that it sounds like based on your career so far, you're interested in looking for things that other people can't find. So the national security space, obviously, and then investing, looking for stocks that other people haven't recognized the upside in conflict studies. This is my own view, but investing is conflict, right? It's you have an opinion on a stock, you think there's upside potential there, someone else doesn't, so they sell it to you, and hopefully you realize the upside. I think the epitome of that is probably in the international space, especially in value. What do you think people often misunderstand about that space, and how does your approach differ?
So I think all of us on the team tend to be students and fans of history, and what we like to focus on our team is very long time horizons. And what you see if you study history is that things can go very out of favor for a long time, and then they can come back. I'm a fan of old maps, and it's funny, you'll see the same cities on a map from 500 years ago. I have a map of the Middle East that shows Kandahar and Kabul, and it's not as though those are the biggest economic hubs in the world, but they're still there. And I think that same approach applies to a lot of the companies that we own. These may be companies that were beloved 10 or 20 years ago. They've fallen on hard times, but there's something in them that allows them to stick around. And international being such a huge and diverse opportunity set just means there's more opportunities for things to fall out of favor, get forgotten, and then eventually come back into the limelight as investors re-engage with the story.
For people that are watching this, listening to this, who may not be familiar with your approach, can you give us sort of a simplified way to think about the way you guys identify opportunities, and what are some of the non-negotiables for a stock to make it into the portfolio?
Sure. So at a basic level, we think that investors tend to over-extrapolate the current environment. So they get overly positive when things are good, and then they get overly negative when things are bad. And as contrarian value investors, we're really focused on that latter category, when people get overly negative, overly pessimistic, and they can't see that good things could ever happen again. And for us, we try to keep things simple. And so every stock that goes into our portfolio ticks the same 5 boxes. It's low price, low valuations, low expectations, strong balance sheets, and lots of upside. And all of those 5 boxes are critical because they all feed into taking advantage of that long-term mispricing. So the low lows, as we call them, low price, low valuations, low expectations, that help us gauge how negative and extreme the market is on a given stock. Strong balance sheets are very important because they allow us to be patient and give time for things to improve fundamentally. And then lots of upside is important. We want to make sure that we're getting compensated for taking the risk on stocks that are at 10 or 20-year lows. So we're typically looking for things to go up 50 to 100% or more. And so all 5 of those boxes are really non-negotiable, and that's how we spend all of our days, is looking through the universe of different companies, trying to see which names tick the 5 boxes, and if they don't, we just say next.
You're making it sound extremely simple. I think we both know it's not. It's very difficult to do this again and again and again. Avoid value traps, pick the right stocks, and obviously realize upside for your investors in a risk-controlled way. Speaking of complex, we're in a very complex macro environment right now. Geopolitical tension, trade wars, energy shocks, inflation fears are coming back into the forefront. So where is that complexity creating mispricing? Is it one particular sector, one region of the world? Are you sort of seeing it all over the place?
Yeah, so I think one thought, as we think about our process, one thing that I really appreciate about it is that it simplifies what we need to do when we come into the office every day. A lot of this complexity involves dealing with tough and often unanswerable questions. It's very hard to know what's going to happen with the Strait of Hormuz or what central banks are going to do with rates. So by having those 5 boxes, it kind of anchors us and gives us marching orders each day when we come in. And so we can focus on the stocks rather than some of the bigger picture macro questions. Now, what can happen is these complexities can lead to certain baskets of stocks starting to tick our boxes. And where we continue to see that in the current environment is in emerging markets. A lot of EM countries are getting pushed to decade lows. They're often treated as geopolitical losers from trade tensions or losers from higher energy prices. And so that's put some really fantastic companies within these countries that might actually be more insulated at 10 or 20-year lows. That could be anything from instant noodles in Indonesia to dairy companies in China. These are market leaders with decade-long experience, great brands. They're operating in countries where the categories are still growing, and we get to buy them at a fraction of the multiples they've traded at historically or the multiples that we see developed market peers trading at. And so the idea is we try to step in, be greedy when others are fearful, buy low, and then just wait patiently there.
Not a lot of household names in your portfolio, I would imagine. And obviously volatility can create good opportunities. Having the framework like you guys do, I think keeps, as you said, it keeps you centered, right? So you can focus on those opportunities, not get distracted by the headlines. One of the other things that I think is unique about your portfolio is your ability to find opportunities down in market cap. So it's not just a large cap portfolio. You're investing in EM as well as developed markets, but also market cap. Can you sort of walk us through the why of investing in smaller companies?
Sure. So, as a reminder, everything that we're looking at is a function of what the market's giving us. And so large cap has outperformed small cap, so we are seeing more opportunities in small cap at the moment. But more broadly, everybody's looking at the largest cap names in the index, and particularly with large cap outperforming, there's even more focus on that. So they tend to be very efficient, very well covered. By going down in the cap spectrum, we think we can find even greater inefficiencies in cases of these stocks kind of irrationally getting sold off. So a good example is in Japan. As international investors have come back to Japan over the last few years, a lot of the focus has been on larger cap stocks, particularly stocks that are in the AI or AI infrastructure space. And that's led a lot of Japanese, domestic, smaller companies to get sold off to unprecedented degrees. So for example, we recently started buying a Japanese eyeglass retailer. They're the largest eyeglass stores in Japan. I visited their stores in Tokyo in February with our Asia-based consumer analyst. And this is a stock that's now trading at decade lows on prices, valuations, very strong balance sheet. And as a reminder, Japan has the highest rate of myopia and the highest rate of glasses wearing in the world. And this is the largest glasses retailer. Now, it's not exciting. It's not AI. I don't know what will happen with AI or Iran, but it seems reasonable that in 3 to 5 years, Japanese people will be buying glasses and the company's earnings should be higher in a couple of years than they are today. And based on that, the stock looks too cheap versus its own history and versus what we see in Europe or the US. So going down in the cap spectrum really allows us to get some of these great businesses that, because they're not as covered, because they might be misunderstood, because they're not as liquid, other investors ignore. And we're really trying to find those inefficiencies for our clients.
I think you just answered my next question in a roundabout way, but it's really about the number of holdings in the portfolio, over 200 plus. A lot of investors like high conviction strategies, a smaller number of holdings. How would you answer the question about how do you have conviction in 200 plus names?
Yeah, so we would be very clear, we are low conviction investors. We are low conviction in any stock, but we're high conviction in the process. So as we said, every stock that goes in ticks the same 5 boxes. But in many cases, these companies are very down and out, and we don't know exactly when they're going to work. So we don't want to make a huge position in something that could take 2 years or it could take 5 years in order to realize our upside. The other thing is that we're always trying to make just slightly more rational decisions on the margin. If you walk in and you have a 5% position down 20%, it's a lot harder to think rationally, take a step back, and consider, is this a place where we should actually be adding, versus if it's a 30 basis point position. So we prefer to have a lot of smaller positions, lower conviction holdings, and hopefully that can help us make slightly more rational decisions on the margin. And I like to think of the portfolio as really a portfolio of options. So we don't know when they might hit, but if they hit, we want them to go up a lot. So if we're going to take a 30 basis point position in a name, we really need it to go up 50 to 100%. So that's where that upside box really comes in.
Yeah, it's not singles. You're looking for home runs, but in a very measured way. All right, this might surprise some of our listeners, but value in international has actually been outperforming growth, not just for the last year or 2 years, but basically for the last 5+ years. Very different than the scene we've seen here in the US, where it's been mega cap tech and some of the biggest companies out there are sort of dominating the indices. Is that a trade? I hesitate to call it a trade, but is that a trend maybe that you think can continue from here in the international space?
Yeah, so we try to be intellectually honest, and if we look at value in the US, I'm not a US expert by any means, but the growth stocks really have outgrown the market in terms of earnings. You mentioned large cap tech, they push margins to new highs. So in many senses, the outperformance of growth seems quite warranted in the US. The same isn't true in international markets. In fact, value stocks have outgrown earnings relative to growth stocks. Despite that, growth stocks, they used to trade in a relatively similar valuation band, but since 2018, growth stocks have traded at a premium to value stocks. And a lot of that seems to have been kind of a halo effect carried over from the US. Now, as you mentioned, over the last few years, that has reversed and value has outperformed growth. But we haven't fully retraced the growth outperformance since 2018 yet. So it would seem that perhaps there's still some room to go for value to get back to valuation parity against growth. And beyond that, since value stocks have outgrown earnings, you could even make the case that maybe some people might assign a premium multiple to the value stocks, given that earnings outperformance. So for now, we're just taking what the market gives us. If we get some great growth companies that start to fall into our zone and tick our 5 boxes, we'll be happy to own those. It's really about what the market's giving us, but for now, it still seems that there's, a bit more room to go in retracing that post-2018 move.
It's a world of stock opportunities, and I think the way you just framed that discussion around international value highlights the opportunity not just in international investing broadly, but in style as well. So what is one thing, based on the discussion we've had today, that you would want an advisor listening to this call to take away?
There's a quote I like by the great philosopher Mike Tyson, and he says, "Discipline is doing things you hate like you love them." And I think our portfolio is all about discipline. So it's not always fun to buy these down and out stocks. Investors ignore or flat out dislike many of the companies when we buy them. A lot of people, when you go to dinner parties, haven't heard of our companies. They're not necessarily doing the most exciting or innovative things. And it can be painful to sit with these companies for years as we wait patiently for things to get better. But we're okay with that. All of the things that make it hard to be disciplined in buying and owning these stocks, hopefully are also the things that make them slightly less efficient, slightly more mispriced. And that's what we're trying to take advantage of. So ultimately, for us, the process, the portfolio comes back to that discipline, the willingness to come in each day, look for the 5 boxes, and focus on these forgotten little corners of the world on behalf of our clients. It's certainly not a style for every investor, and it may not be a product for every client, but I'd say it's the only way that at least I know how to do it.
Come on, Tarit. I think you're selling yourself short here. I'm going to steal that story about the Japanese eyeglass company and myopia in Japan as a cocktail party story. I want to thank you for your time today and your perspective, and we'll talk again soon.
Thanks, John. Appreciate it.